point is, how does a dealer get the gold? Because there's so much gold for sale that they pay people less than the spot price for the coin.
Wow.
So you go in to sell your coin, it sells for less than spot, and I can buy it for $30 over spot. What does that tell you? There's plenty of gold. Now, I don't know if that'll be the case forever and ever, but what I'm trying to explain to you is, like, I get these bizarre messages from people where it's like, they're angry with me because I'm not saying gold's going to go to like $10,000. I'm like, yeah, it's probably going to go to $10,000, and it's going to probably be like a little while before that happens.
As 2024 unfolds, the gold market has captured the attention of investors worldwide, with the precious metal soaring to unprecedented heights. Driven by a surge in demand from central banks and retail investors, gold has repeatedly shattered its price records, prompting financial experts to speculate on its future trajectory. Offering a more measured perspective, EBTucker, a respected financial expert and gold market analyst, notes that gold dealers buy below spot price and sell at low margins, indicating abundant supply. However, he warns this favorable buying environment may not last. While he agrees gold could reach $10,000, Tucker stresses it will take time. Peter Schiff, a well-known advocate for gold and critic of the dollar, forecasts that gold could reach $10,000. Gold has fallen to the $2,650 range per troy ounce as traders take profits following last week's nearly 1.4% rally to new all-time highs. The metal is on track for a third consecutive weekly gain, reaching new record highs in U.S. trading. Tucker also advocates for a pragmatic approach to building wealth through hard assets. He suggests that allocating just 5% of a $10,000 monthly salary to investments like gold or Bitcoin can yield significant returns over time. This strategy, Tucker argues, is validated by gold's consistent long-term appreciation. Indeed, throughout history, gold has maintained its status as a unique and coveted commodity. Its ability to serve as a bulwark against inflationary and deflationary pressures, coupled with its role as a portfolio diversifier, continues to attract investors. In geopolitical tensions and macroeconomic instability, gold's allure as a global safe haven asset only intensifies. Before we begin this video, please subscribe to our channel so you never miss an update. Also, remember to hit the bell icon and share this video with anyone who might benefit from it.
Let's talk a little bit about gold and silver, because I know people want to hear about that. Let me just tell you a couple things. This is going to create a lot of angry comments but I get these bizarre emails at my newsletter, EBTucker.com. I get these bizarre emails in the comment section.
Right.
Because people are angry with my view of gold. This is my view of gold. Okay, so like if you are earning, let's say $10,000 a month for, your job, and you were to buy hypothetically like 5% of your salary in various hard assets, right? Let's just say maybe gold, maybe a tiny bit of Bitcoin or something, whatever you want to do. It doesn't really matter. But let's say you did that for a long time. You get to the point where it's like you have a chunk of gold or whatever it is you want, silver, it doesn't really matter. You have a chunk of it and it's done pretty well. It's done pretty darn well, right? You look at the chart of gold, 26 and a quarter, like
massive.
It's stairway to heaven, right? And so the thing is that everybody is thinking like, oh, the central banks are buying gold. I'm like, doesn't matter. Oh, the Russians are doing gold. Doesn't matter. Why does it not matter? I'll tell you why. Because I could buy as many coins, as many 1 ounce coins as I want right now for $30 over spot. And that's not because that's an internet website. I'm not going to say like which one because it doesn't matter, because there's many of them you could go to. Go wherever you want. But I can buy so many coins that I could buy as many as I want, shipped right to my doorstep for $30 over spot. That's like 1.25%, maybe like 115 basis points or something, maybe barely 100 basis points.
Right.
What does that tell you? Well, that tells you that the dealers, because the dealers can't run their business for $30 an ounce. You can't even. I've been to all the dealer vaults. Like they got guys with Uzis walking around. Okay, it's like, yeah, it's crazy. So I mean, they have like $1 billion of the gold. You better have like lots of security. Right. Those guys aren't working for free. So my point is, how does a dealer get the gold? Because there's so much gold for sale that they pay people less than the spot price for the coin. So what does that tell you? There's plenty of gold. Now, I don't know if that'll be the case forever and ever. But what I'm trying to explain to you is, like, I get these bizarre messages from people where it's like they're angry with me because I'm not saying gold's going to go to like $10,000. I'm like, yeah, it's probably going to go to $10,000, and it's going to probably be like a little while before that happens.
Like 100 years or something.
Oh yeah, maybe less than that. But like the numbers can get, you notice like a 27% year, which is what we're having, right? 27% year, the numbers get a little big, right? I mean, you have another 27% year over
it's massive.
So I mean, so you have to understand that it's all about percentages.
Tucker has identified an unusual phenomenon in the gold market. Dealers can purchase gold below the spot price and sell it with narrow profit margins. Typically, this scenario indicates abundant supply, creating a buyer's market with favorable conditions for those looking to acquire the precious metal. However, the technical picture tells a different story. Despite a recent pullback from record highs, gold maintains an uptrend across short, medium, and long-term timeframes. This persistent bullish trend contradicts what one might expect, given the apparent abundance of supply. Adding another layer of complexity, the relative strength index, a key momentum indicator, suggests that gold remains in overbought territory. This overbought condition typically acts as a warning sign for traders, cautioning against adding to long positions at current levels. The high RSY reading aligns more closely with the bullish price trend than with the fundamental supply situation described by Tucker. Tucker adds a note of caution to this already intricate scenario, warning that the current buyer-friendly environment may not last indefinitely. This suggestion of potential future market shifts adds an element of urgency for those considering taking advantage of the current supply dynamics. Let's get back to the interview.
What I'm trying to say in my newsletter is like, I'm killing it owning physical gold.
Right.
I'm killing it. I mean, think about it. Like, I'm beating most of the indexes with physical gold. I mean, like physical gold that can't be like hijacked by ransom or whatever. I mean, you can't even find it all. Believe me.
Wow.
People are like, what happens if the bank gets closed? Doesn't matter. You got, like the beach house. Okay. So it's like, you don't even care, right? You're just like, the point is you buy it however you want, but like there's plenty of gold. And the reason there's plenty of gold, not only, I mean, people are selling, whatever, but the reason this is happening is because the gold price has nothing to do with what's physically available. It's all about, it's a traded vehicle. The futures price sets the spot price. Okay. Like that's like the nickel market. Do you remember what happened with the nickel? It went to like $50, it's $7 now. Okay. So it's the same thing, except for gold is more liquid, right? So the gold price goes where the futures market tells it to go. It doesn't matter. Now, eventually it matters in the sense that you need some underlying metal somewhere to satisfy. Okay. But where did you get that metal? Did you notice that Argentina, which by the way, I go to Argentina once a year and always in my newsletter, I report the situation. I go to the same restaurants and talk to the same people. Argentina is like somewhat becoming like a more stable scenario right now. It is just kind of like settling out, whatever, off of a very volatile few years. Did you notice that they sent all their gold to London? And think about that. They're sending it into the gold pool, okay? Sure, it's still their gold, okay? But now it's going to be a notation on the books, which means it's going to be sitting in the vault to be worked in the futures market, okay? People just refuse to understand this is how it works. But all this trading that you see over here, all this stuff has nothing to do with physical gold. The amount of physical gold being settled in the futures contracts is extremely low. It's almost all trading mechanism. And what that means is you think unemployment's going to be this, you take this like huge multi-day option position, you take options on futures. Okay. So you have the futures contract. So you have December delivery 100-ounce COMEX. Then you have an option contract between now and December on a strike in that futures contract. I hope you're following me. What you get is excessive leverage. You get massive. So then unemployment, you notice at 8 o'clock in the morning or 8:30, this machine reads me all the government releases. So it'll come on and it'll say unemployment 100,000, whatever. And the gold price moves $30. So that option on December future just went bananas. And then what do? You cover. So you're out of that thing. You're done. You don't have anything to do with a physical ounce of gold. Does this make sense? This is why
it's all futures markets.
Now, also, forget about this notion that it's manipulated. Forget about it. It doesn't matter. It doesn't matter because what matters is like you have to decide what game you're going to play. And for me, for a long time, I've been playing the 5% game. And the people that read my newsletter are angry about that. And I'm like, why are you so angry? This year, I'm up 27% on physical blocks of gold. I love it. People are like, well, what about, you have to pay someone to store it. It's cost almost nothing. I mean, you can put it all over the place. People store it for next to nothing. Well, what about it doesn't pay a dividend? Who cares? You have to pay 40% income tax and dividends. It's 36 plus 3.8. Same thing, 40. Who cares about dividends? You don't want dividends. I mean, it's like the last thing you want is like more income. What you want is the 27% a year. And then I don't know if you know this, but the mining stocks aren't moving.
The gold and silver markets are experiencing a situation where dealers buy gold below the spot price and sell at narrow margins, indicating oversupply. While this benefits buyers, it may not be sustainable. Despite a recent decline from record highs, both metals remain in an upward trend, bolstered by their roles as safe havens and inflation hedges. What are your predictions for the gold and silver markets in the coming months? Let us know your thoughts in the comments below. If you found this video helpful, please like, subscribe, and hit the bell icon for more updates. Thank you for watching. Until next time, stay informed and invest wisely.